Good afternoon, everyone, and welcome to our webinar, America's Diverse Family Farms 2016 edition. My name is Kelly Mendonca, and I will be your host. This webinar is being recorded and will be posted on the ERS website next week. At any time during the webinar, you may enter a question into the chat feature at the bottom left corner of your screen, and our speaker will answer at the end of his presentation. Our speaker today is Bob Hoppe. Bob is an economist in the Structure, Technology, and Productivity branch at the Economic Research Service, U.S. Department of Agriculture. In addition to authoring America's Diverse Family Farms, Bob's areas of research also include general farm structure, small farms, large-scale farms, and women farmers. I think we're ready to start. So Bob, you can now begin your presentation.
Hi, I'm Bob Hoppe. I'm going to be talking about America's Diverse Family Farms, the 2016 edition. That's a brochure that was published by ERS last December 2016. The brochure emphasizes the diversity of farms in the United States. Information about the different types of farms is important in understanding the farm sector and the farmers that are involved in farming. One of the main conclusions of the brochure is that farming is still overwhelmingly an industry of family businesses, but these family businesses differ in size and other characteristics. Most of the data are from the 2015 Agricultural Resource Management Survey, or ARMS. ARMS is an annual survey of farm businesses and the associated principal operators that run the farms. A principal operator is the operator most responsible for running the farm. ARMS uses sample weights to accurately represent farms in production in the United States. It's conducted by the National Agricultural Statistics Service, or NASS, and ERS. We also have one slide that's based on Census of Agriculture data, but other than that, the data is from ARMS. Before we get any further, we need to do some definitions of farms and family farms. A farm is any place that's sold or normally would have sold at least $1,000 worth of farm products in any given year. It's the standard USDA definition. And a family farm is any farm where the majority of the business is owned by the operator, the principal operator, and people are related to the principal operator. The relatives do not need to live in the same household as the operator. They can live someplace else. By this definition, about 99% of U.S. farms are classified as family farms. Now, the $1,000 definition means that there's many farms that are going to be counted in the farm count, even though they have very little production and their sales are limited. So as a result, farms are very diverse. They range all the way from small retirement and residential farms all the way up to enterprises with sales in millions of dollars. Now, in response to the diversity of U.S. farms, ERS developed its farm typology, which leads us to the next slide. Okay, typology classifies farms into more homogeneous groups based on whether the farm is a family farm or not. Farm size, which we measure by gross revenue. For our measure of gross revenue, we add the sum of crop and livestock cash receipts, government payments, and other farm-related income such as custom work or production contract fees, and it's measured before subtracting expenses. And then finally, for the third criteria, for small farms, occupation of the principal operator is used to separate farms into different categories. The main goal of the classification is to classify farms together that have similar characteristics. Okay, the typology starts by looking at small family farms, and that's defined as any farm that has gross revenue of less than $350,000. And these farms are divided further based on the occupation of the operator. We have retirement farms, off-farm occupation farms, and farming occupation farms. Now, the last group we subdivide into two categories: the low sales farms that have gross revenue less than $150,000, and moderate sales farms that have gross revenues of $150,000 up to $349,000. That gets us out of the small farm category. The next largest category is mid-sized family farms. The gross revenue of these farms ranges between $350,000 and just under $1 million. Okay, large-scale family farms have gross revenue of at least $1 million, and this is subdivided into two groups: large family farms with revenue between $1 million and just under $4 million, and very large family farms with gross revenue above $5 million, or equal or greater than $5 million. That only leaves non-family farms. These are farms that didn't meet the family farm definition. The operators and the people related to the operator do not own a majority of the business. A little bit more information on non-family farms. They're not just large farms operated by publicly held corporations. A common example of a non-family farm would be a farm run by unrelated business partners, or another example might be a farm that's operated by a hired manager for a family of absentee land owners. And not all these farms are large either. 61% of non-family farms are small and have gross revenue less than $350,000. Next, we're going to look at the distribution of the number of farms, land operated, and the value of production among the different farm types. I'm going to focus on the red slice of the pies first. That's small family farms. They account for 90% of all farms. They operate about half the farmland, and their value of production, though, is only about a quarter of the value of production for the U.S. But there are some commodities where small farms are particularly important. They account for about 57% of poultry and eggs, mostly under contract, and 52% of hay. The largest share of production occurs among large-scale family farms at 42%, and they're doing that with only 3% of the farms. If you add up all the family farm slices there, the family farms of different types together account for 99% of farms and 89% of production. Now, a large-scale family farm's current share of production reflects a long-term shift in production to larger farms. What we're looking at in the top two layers in the graph are million-dollar farms. There are farms that have gross revenues above $1 million. We divide that into two groups: smaller million-dollar farms that range in revenue from $1 million to just under $5 million, and then larger million-dollar farms from $5 million and up. And you're over at the left-hand side. In 1991, they had about a third of agricultural production. By 2015, they had a little bit more than half. The larger million-dollar farms account for about 23% of production in 2015, and the smaller million-dollar farms accounted for 29%. The specialization differs between the two groups. The larger million-dollar farms are about 38% of them specialize in specialty crops like vegetables, fruits, and tree nuts, and so forth, and another 25 specialize in dairy. And about half the smaller million-dollar farms specialize in cash grains. Now, those million-dollar farms we were looking at in the previous slide included both family and non-family farms. And if you look at how those million-dollar farms were organized, about 90% were family farms. Non-family corporations only amounted to about 3%, and 80% of the non-family corporations reported no more than 10 shareholders. And the other slice there, the yellow other slice, that's the people like the unrelated partners that we were talking about before. Now, this graph is the one that's based on census data. We started with the 1982 census and then looked at cropland over the next 1, 2, 3, 4, 5, 6, 7 censuses to 2012, the most current census. And we calculated the average cropland per crop farm each year. And it stays right above, just above 200, despite the shift in production upward. Yeah, I think if I remember correctly, the range is like from 222 acres to 259 acres, something on that order. So the bottom line there, the mean cropland doesn't really vary very much. But changes were happening. The changes in total cropland were fairly small, but the largest and smallest crop farms grew in number, but the farms in the middle declined. But overall, the total number of crop farms changed. They did not change. The numbers stayed the same, but who actually made that up changed. So with only small changes in total cropland and total crop farms, acreages just kind of meandered. And we have another measure called midpoint for cropland. In 1982, it was 600 acres. The way you interpret that is in 1982, half the land was on farms that had more than 600 acres, and half the land was on farms that had less than 600 acres. So by 2012, the midpoint increased to about 1,200 acres. So that meant by that time, half the acres were on farms with 1,200 acres, and then half was on farms with less than 1,200 acres. So you can see the shift in concentration upwards here. Now, one thing that was contributed to this was that technology allowed farmers a single farmer or a single farm family to operate more and more acres. Now we're back to ARMS data again. This shows the how profitability differs by farm size in 2015. Our measure of profit here is the operating profit margin, which is the ratio of operating profit to gross income. And operating profit is essentially it's just net income plus interest minus an adjustment for unpaid labor. And what it measures is the resource that's available to fund a farm's business capital, which is critical to a farm continuing business. And for each typology group, we divided farms into 3 categories based on their risk of potential fiscal problems. The red category is the red zone. That's a relatively high risk of fiscal problems, financial problems. Operating margin was less than 10%. In the yellow zone, it's medium risk level, and it's the operating profit margin ran from 10 to 25%. And then the green zone is a low risk level, and that's for farms that have an operating profit margin of greater than 25%. The thing that's striking about small farms is a large share that's in the red zone. It ranges from 59% to 74%. Now, small farms typically rely heavily on off-farm income, so the chances are they're not going to go out of business immediately. They can hang on. Now, other small farms are more profitable. There's about 14 to 27% of the small farm groups were in the green zone. But the share that's in the green zone increases with size once you get away from the small farm categories. You can see it go up with size as we move from mid-sized family farms to large and very large family farms. And you'll note that none of the mid-sized and large-scale farm categories had a majority of their farms in the red zone. The next couple of slides, we're going to be looking at 2 USDA supports for farming, government payments, and federal crop insurance. This graph is set up a little bit differently than the ones we've been looking at. If you look at the 3 colored bars, we've got conservation reserve program payments, working land conservation payments, and commodity-related payments. And what we're looking at is the distribution of each of these types of payments over all farms in the United States. So the bars of a given color add up to 100%. So if you took for instance, the Conservation Reserve Program and added the 33% for retirement farms, added in the 27% for off-farm occupation farms, went down, down the line like that, all those bars would add up to 100%. And this represents the distribution as of 2015, and it's from ARMS. Now, one thing that's striking is that most payments from commodity work related, that's the red bars, and the working land conservation programs, that's the light blue bars, go to three groups: the moderate sales, mid-size, and large categories. These programs are targeted at production-specific commodity. About 74% of the payments went to these three groups. And something similar happened if you look at the light blue working land bars. In those same three groups, moderate size, mid-size, and large, the share of payments that went to those three groups was 80%. And these programs also target production indirectly by focusing on land that's in production. But the Conservation Reserve Program is a little bit different. It pays farmers to take environmentally sensitive land out of production. Retirement, off-farm occupation, and low sales farms received about 79% of these payments in 2015. Well, one important thing to remember is that not all farms get government payments. 72% of all farms received no government payments in 2015. And this graph is similar to the previous one, except it's looking at federal crop insurance. Now, federal crop insurance insures farmers against losses from things like bad weather, for example. The indemnities, that's the red bars, are payments from crop insurance to compensate for losses. And they're roughly proportional to 2 acres of cropland. And again, this is as before, the bars of a given color add up to 100%. Also remember that the indemnities are not included in the previous government payments graph. They're separate programs and they have separate data. Now, mid-size and large family farms together receive about 69% of indemnities, and partially that reflects the participation in the programs. About 2/3 of mid-size farms and 3/4 of large farms participate in federal crop insurance. Overall, only about 1/6 of U.S. farms participated in the insurance program. And federal crop insurance has grown in recent decades. The amount of land insured tripled from about 1 million acres in 1989 to 300 million acres in 2015. And next we're going to look at operator household income. Each bar gives the operator household income for that farm type, the median. It's in thousands, so the 63 in the retirement category, for instance, means 63,000. The income includes income from both farm and off-farm sources. And the box up at the top gives some figures we're going to use for comparisons. The median income for all U.S. households, and the median income for all U.S. households with a self-employed head. Now, for each type of farm operator household, the income is higher than the $52,000 median for all U.S. households. And this is true for small farm households despite their low profitability levels. These households, particularly those operating in retirement, off-farm, and low sales farms, rely heavily on off-farm income. Now, since farmers are self-employed, we also compared farm operator household income with that for all U.S. households that report a self-employed head. And for all farms, the two estimates were fairly close. For all farm households, the median household income was $77,000, which is practically identical to the median for U.S. households that are self-employed at 78,000. In most cases, for most typology groups, the operator household income was larger than the comparable one for the self-employed at the U.S. level. The exceptions were retirement and low sales farms, which were somewhat below the U.S. average for households with a self-employed head. Now, income is important to farm households' well-being, but so is their wealth. This graph is set up similar to the previous one, except it's looking at household wealth instead of income. Each bar shows the median household wealth in thousands of dollars for a given farm type in 2015. Wealth here is equal to net worth minus the difference between assets and liabilities. And in this case, we're considering both farm and non-farm assets and liabilities. And again, the box gives some median figures for all U.S. households and households with a self-employed head for comparative purposes. Now, median wealth for all operator households was $827,000 in 2015. That reflects the value of their assets, especially farmland, and then the relatively low debt levels of some farmers. Now, for each type of farm household, median wealth was higher than that for all U.S. households at $82,000, and U.S. households with a self-employed head at $365,000. Oh, and only 3% of farm households had less wealth than the median for all U.S. households. That's kind of the highlights from the brochure. We'll close with some conclusions and implications. Farming is still overwhelmingly made up of family businesses. They account for, family farms account for 99% of all farms and about 90% of production. Small farms account for 90% of the farm count, but only 24% of production. The largest share of production actually occurs on large-scale family farms. Production has shifted to farms with gross revenues of $1 million or more since 1991, but most of the farms this large are still family farms, and those organized as non-family corporations generally have no more than 10 stockholders. CRP payments go to different farms than the other government payments. CRP targets environmentally sensitive land, and their payments go largely to retirement, off-farm occupation, and low sales farms. And commodity-related and working land payments target production, either directly or indirectly, so they go to moderate sales, mid-size, and large family farms. Distribution of crop insurance is roughly proportional to cropland. As a result, mid-size and large family farms receive about 69% of indemnities. And farm households in general are neither low income nor wealth. For each typology group, both median household income and wealth are above the medians for all U.S. households. If you'd like to contact us about the brochure or related topics, you can see our email addresses here. The report itself is available on the web, on our website. We also have a farm structure and organization topic page that might be interesting to you. And we have an ERS farm web tool that allows you to use ARMS data to generate your own tables using various classification variables, including the typology. This concludes the presentation.
Thank you, Bob. We have a few questions for you, so I will tell you about those right now. Jim is asking, in your presentation, you show that a number of small family farms is about 90% of all farms. You hear a lot about farms increasing in size and consolidation. Is that true, and how is that reflected by the ERS typology?
Well, what's happened over the years is the farms in the middle-sized classes have either gone out of business or downsized to a retirement farm perhaps, or gotten bigger and gone into a larger farm category. But there's a large over the years there's been a large increase in very small farms, let's say with gross sales or gross revenue less than $10,000. And that kind of stabilizes the count, but the production is shifting to the larger farms.
Alrighty, and we have another question from Melissa. Operating profit margins seem very low for all farms, but especially small ones. Why or how do they stay in business, or do they? Or are they replaced every year by other small, unprofitable farms?
Well, in the operating profit margin, there's a deduction for the opportunity cost of the farmer and farm household labor on farms that are not incorporated. So that means that, and that's generally it's estimated by taking the hours of work provided by the farm and the farm family, multiplying it by a regional farm average. So that's not a cash expense. So if the farmer can accept a low rate of return on his labor, he can still keep in business. Another thing that can happen is they can basically live on their off-farm earnings, whatever they have as a job or other source of off-farm income. That might make sense, particularly if land was appreciating and they wanted to hold on to land as an investment. So that, given that they work, a lot of them work off farm or are semi-retired and they're getting retirement income, they aren't totally reliant on the farm income, so they can get by.
All right, we have a question from Richard. Has the cost of farmland gone up very much over the last 10 years?
Yes, I believe it has. That's outside my area, but
all right, and I've got a question from Jonathan. The long-standing trend toward big farms accounting for bigger percentages of production, is there any reason to think that will change anytime soon?
That's a good question. And in some of the other countries in the world, they've gotten really huge farms, like in excess of 25,000 acres or but it seems like in the United States there's some characteristics of small farms that help them, or family farms that help them continue. They have some flexibility on working off farm during high labor period, low labor periods on the farm. They can, in economies of scale. It's not like automobile manufacturing. There's huge economies of scale. A lot of the economies of scale can be captured at a fairly low level. Now, whether this, and then the other thing is that farming requires kind of a very intense local knowledge base about how, about soils on your farm and local pests and how cattle react to the weather in your area. So that. And this takes a long time to learn, and it's not easily taught. So there are some advantages that small farm operators and family farm operators do have.
All right, Keith is asking a question. Lawmakers often compare family farms to large corporate farms. Now, since over 90% of farms are family farms, do you think this is a misrepresentation? Are they confusing the word corporate for the word large?
I think there's an element of confusion of corporate with the word large. Some of these family farms are quite large, but they're still run as a family business.
Thank you. And we have a question from Martha. Does ERS calculate midpoint acreages for individual crops? And where would we find a difference between like cattle or fruit or vegetable crops among this data?
Yeah, we've calculated the midpoint acreages for a variety of crops, and over the period we look at, like from generally 1987 to 2012, they tend to kind of double or triple. And in the it's a little bit different and that's true for field crops and specialty crops. It's pretty universal. In the case of livestock, the increases can be really startling. Like what's happened recently in hogs. We would calculate the head of dairy cattle, and use that instead of acreage to get the midpoint. And and dairy and hogs have had a big increase recently, and then in the past, in the 60s and 70s, something similar happened to broilers and fed cattle on feedlots. In the case of the livestock, it's more like there's some big industrial or big changes in the industry, like the introducing of integration to the broilers that causes a real large increase for a period and then it kind of levels off. But yes, we've done a report in 2013 and looked at midpoints in various crops and livestock. If the person's interested, I can get their contact information and I can send them the link to that report.
All right. Thank you, Bob. Well, I think that's all the questions we have time for today. So thank you all for joining us, and have a great day.